Good morning, everyone. My name is Xihao from the School of Management at Sichuan Agricultural University. Today, I'm presenting my paper, WACC-NPV Framework and Evaluation of Risk Projects, a literature review. This paper asks a practical question in entrepreneurial finance. When venture capital projects are highly risky and uncertain, how useful is the classic WACC-NPV framework? My answer is deliberately balanced. The framework is still vulnerable for thinking about value creation, but it should not be used mechanically as a standalone valuation tool for startups. This talk follows a simple path. First, I review the traditional logic of NPV and WACC. Second, I explain why venture projects are special, especially through uncertainty, information asymmetry, and Third, I compare commonly used valuation methods in the literature. Finally, I discuss where WACC-NPV helps, where it reaches its boundaries, and how it can be supplemented. The goal is not to reject traditional finance theory, is to locate its proper role in venture capital evaluation. At the center of the paper is attention. Traditional corporate finance assumes that projects can be evaluated through future cash flows and a discount rate. Venture capital projects, however, are often early stage, loss-making, and dependent on a future exit. This creates the key question: can we still rely on WACC-NPV? My view is that it remains a strong conceptual framework, but the inputs required by the model are much less stable in venture capital. NPV starts from a very intuitive idea. Future cash flows are worth less than cash today, so we discount them back to present value and subtract the initial investment. The decision rule is also clear. If NPV is positive, the project creates value. If it is negative, it should be rejected. In the paper, I emphasize that NPV is a normative tool for value creation, but it depends heavily on two inputs: cash flow forecast and the discount rate. WACC provides the theoretical benchmark for the discount rate. It combines the cost of equity and the after-tax cost of debt according to the firm's capital structure. In mature firms, this is powerful because capital sources and financing costs can be observed more clearly. But the paper also notes that firms may use discount rates above theoretical capital cost, reflecting execution difficulty and additional risk compensation. This point becomes very important when we move to venture capital. Venture capital projects differ from mature corporate projects in three ways. First, the firms are usually young and have limited operating histories. Second, the risks include not only business fluctuations, but also technological failure, market acceptance, and financing interruptions. Third, returns are usually realized through an exit, such as an IPO, merger and acquisition, or equity transfer. So the value judgment is forward-looking and context-dependent. The valuation problem is not only that data are incomplete, it is that the value of a startup often depends on future states that have not happened yet. Cash flows are hard to predict, and entrepreneurs usually know much more than outside investors about technology, product quality, team capability, and market prospects. Because of this, investors often pay attention to non-financial signals, such as the funding team, market space, trademarks, or other indicators of commercialization potential. The literature does not treat WACC-NPV as the only valuation method. DCF is close to the traditional framework, but in venture capital, it is often more of a theoretical reference. The venture capital method starts from accepted exit value and works backward using the investor's target return. Relative valuation use comparable companies when cash flow data are weak. Scenario analysis helps when several future outcomes are plausible. These methods are best understood as supplements, not as a rejection of WACC-NPV. So, what does WACC-NPV still explain? It gives the basic chain of value, future earnings, capital cost, and current value. Even when venture capitalists talk about the team, market space, or exit opportunities, these factors matter because they affect future earnings or risk compensation. In this sense, WACC-NPV provides interpretive power. It helps us understand why a project may create value, even if it cannot always produce a precise startup valuation. The first boundary is the discount rate. WACC works best when capital structure is relatively clear and financing costs can be identified. Startups are different. Their equity ratio, control rights, and capital cost can change across financing rounds. Early-stage firms also lack public market price and sufficient comparable samples. Therefore, the required return in venture capital is not just a clean financial capital cost. It includes failure probability, financing uncertainty, exit risk, and governance cost. The second boundary is cash flow forecasting. NPV requires relatively stable forecasts, but a startup's value often lies in growth opportunities, technological potential, and market positioning rather than current operating cash flows. The literature also suggests that startup valuations may be influenced by comparable company valuations and investor attention. This means the valuation is not purely fundamentals driven. It is also shaped by expectations and market context. The third boundary concerns exits and contracts. In venture capital, returns are realized only if the exit route actually works. Moreover, the surface financing valuation may not equal the true economic value because preferred shares, liquidation preferences, and different equity rights redistribute returns under different outcomes. So, when applying discounted logic, we must ask a further question: whose future earnings are being discounted and under what contractual conditions? To conclude, the paper argues for a balanced position. The WACC-NPV framework is not obsolete in venture capital. It remains useful for explaining value creation, capital cost, and required returns. But it is not sufficient as an independent operational tool for startup valuation. A better approach is to use it as a foundation and combine it with the venture capital method, relative valuation, and scenario analysis. The limitation of this paper is that it is a literature review. So future research can aid empirical tests, case study, industry comparisons, and financing round analysis. Thank you.